Happy New Year. It's Friday, January 6th, and we just completed a very volatile first week of the year. The Fed has started to accelerate its quantitative tightening program. After a brief pause in the middle of December, they did do some quantitative tightening at the end of December and also did $43.7 billion in quantitative tightening through January 4th, so through Wednesday of this week. That is a large number, and that's primarily because the treasuries are starting to run off. There's a big runoff of treasuries here over the next 2 weeks, so I would expect quantitative tightening to be pretty strong over the next couple of weeks. But please remember, we have a long way to go on this. We got to $8.9 trillion. We are now down to $8.5 trillion. So we're down, $400 billion. So that is a lot of money, but really not a lot of money for the Fed since they managed just to print money out of thin air. So we've got a long way to go. We started at $800 billion in total. Back in 2008, we got to $8.9 trillion. So we've taken $400 billion out. So we've scratched the surface. The Fed will probably continue to do quantitative tightening, which is going to have a major impact on the markets. That's one of the reasons the volatility is so high. Liquidity is definitely drying up. Bond rates have moved up. Auctions have gotten a little more difficult to pull off. And as this big buyer, the Fed, is no longer buying treasuries and mortgage-backed securities and actually allowing those securities to roll off, reducing cash in the system. The item that the market seems to be focused on, or at least the media is focused on, is the federal funds rate. That has moved up to 4.5%, but please remember this is still well below the year-over-year inflation rate of 7.1%. Historically, inflation is not cracked until the Fed funds rate is over the inflation rate. The inflation rate is definitely coming down, and we'll probably have a pretty benign inflation number next week, as we've had a big drop in crude oil prices, natural gas prices, and that's going to flow through to the system. These are primarily going to be reversed, in my opinion, as China comes back on demand. That could be as much as an additional 2 million barrels a day in additional demand, and the reversal of the Strategic Petroleum Reserve, drawing down 1 million barrels a day and actually starting maybe to even refill. So the crude market is going to get a lot tighter here over the next couple of months. So I would expect January to be an announcement to be pretty much the last benign inflation report for a while. So we've got that problem still facing us, coupled with quantitative tightening. The Fed officials have come out this week and basically have said that 5% for a sustained period into 2024 is the Fed funds rate that they foresee. The market is hoping that we're going to have a reversal of Fed funds rate sooner than that. I would tend to think that's not going to happen because inflation is not going to get below 5% on a year-over-year basis for the foreseeable future, in my opinion. So all that said, quantitative tightening is rolling on, about to accelerate. Fed funds rate are probably still heading up a little bit toward 5%. I would stay cautious. I have reduced my cash positions, but I still maintain above average cash. I hope you find this information helpful. Please take a look at buildingbenjamins.com, where you can see our full disclaimer. And remember, this is not investment advice. This is just how I'm handling my personal portfolio. Hope everyone had a great holidays and has a great new year. Thank you.